Welcome back to Iron Financial. I'm your lead analyst, and in this explainer, our mission is to show you exactly how to forge a stronger portfolio and really cut through the relentless market weakness we've all been seeing lately. Let's just frame the macro environment for a second here. Right now, we're dealing with incredibly sticky inflation, completely wild interest rate uncertainty from the Fed, and a market breadth that has frankly narrowed down to just a handful of mega-cap tech stocks. I mean, let's be real, everyone else is just struggling to keep the lights on right now. Building a portfolio in this kind of punishing environment requires stocks with absolute, unshakable structural integrity. You simply cannot build a skyscraper on a foundation of sand, and you definitely cannot build generational wealth on companies that are actively bleeding cash. You need heavy lifters. You need iron. And today, we are tearing down a company that is absolutely demanding the market's attention right now, Tower Semiconductor, ticker symbol TSEM.
Hey everyone, I'm the Market Skeptic. And as always, my job is to represent you, the audience. Because I'll be honest, whenever I hear a phrase like structural integrity, my warning sirens immediately start going off. There are a lot of glass cannons out there in the market right now, masquerading as solid, safe investments. So my question today is simple. Is this a truly solid foundation we're looking at? Or is this just another massive AI hype cycle propped up by retail investors who are unfortunately about to be left holding the bag?
Look at this number. 379%. That is Tower Semiconductor's massive stock surge from its April 2025 lows of around $28.54 a share. I really want to put that into perspective for a minute. While the broader S&P 500 has been grinding out pretty mediocre single-digit gains, and small caps have been outright suffering in what's essentially a sluggish tape, this stock rockets up nearly 400% in roughly a single year. When I see an anomaly like that staring me in the face, I have to ask the hard question. Is this vertical climb built on actual durable business fundamentals? Or is this just a fragile scaffolding of artificial intelligence hype that is going to structurally collapse the exact moment the macroeconomic wind changes direction? And that is exactly what we are here to find out today. We are not just going to skim the top-line earnings numbers, we are going to measure the actual underlying quality of that revenue. We're looking for real poured concrete here, not just cosmetic spray foam. We are going to drill down incredibly deep into the freshly released Q1 2026 earnings numbers. We are going to completely tear apart their balance sheet, and we're going to look at the forward guidance to determine if this foundation is actually curing properly. We need to know without a shadow of a doubt if TSEM is forging real wealth or if they are setting up a massive value trap at the very top of the market cycle. So let's get to work. Section 1, Top Line Drill Down. We're going to begin the heavy lifting with the top-line foundation. These are the specific metrics revealed in the May 13th, 2026 earnings report, and they represent the initial stress test that will tell us if the underlying business is actually structurally sound. Okay, let's look at Q1 2026. Tower delivered revenue of $413.6 million. Now that's up from $358.2 million in the first quarter of 2025, which right off the bat represents a very solid 15% year-over-year revenue growth. But listen, the top line only tells half the story, right? The real strength of any manufacturing business is found in its operating leverage. Check this out. Gross profit didn't just grow 15% along with the revenue. It exploded. It went from $73 million all the way up to $111 million. And their operating profit? It literally almost doubled, going from $33 million in Q1 2025 all the way up to $64.6 million.
Okay, hold on. I hear the numbers, but I really need to probe the mechanics of this because, frankly, it sounds a little too good to be true. A 52% gross profit growth on only 15% revenue growth? That is highly suspicious if you don't actually understand the why behind it. Where is this sudden burst of top-line strength actually coming from underneath the surface? Companies don't just magically double their operating profits without a massive fundamental shift in what they are actually selling. To double operating profit like that in a single year, you're either slashing internal costs to the bone, which we all know is unsustainable, or you have completely changed your product mix. Which one is it?
You hit the nail on the head. It is entirely driven by a fundamental change in the product mix. What we're looking at here is a structural shift in the company's entire business model. The breakdown of Q4 2025 revenue versus the prior year shows a complete rewiring of their revenue streams. Look at RF infrastructure. It absolutely ate up 32% of the total revenue pie.
Right, and if I recall, in the previous year, it was only around 20%. So what you're saying is they are deliberately crowding out their lower margin legacy products?
Exactly. Spot on. The discrete products category shrank from 14%
down to just 9%. They are actively de-emphasizing and shedding those weak, lower-tier commodity products to make room on the factory floor for the high-margin heavy hitters. It's like they're ripping out the cheap drywall and installing solid, load-bearing steel beams. Let me just hammer this home with the absolute dollar figures so you can really grasp the scale of this transition. Back in Q4 2024, RF infrastructure brought in $69.7 million. Fast forward exactly 1 year to Q4 2025, and that segment alone pulled in $140.9 million. Guys, that is a staggering 102% growth in their absolute most critical segment. And just for some context here, RF infrastructure isn't just your basic run-of-the-mill circuitry. These are the highly complex chips required for 5G cell towers, advanced aerospace connectivity, and massive data transmission pipes. So they aren't just selling more chips, they are selling a completely different, vastly more profitable mix of technology that the modern global economy desperately needs right now. Section 2, Structural Integrity, Expanding Margins. Okay, I'll concede that the product mix has changed, but I'm pushing back hard here because we've seen this movie before. We have seen semiconductor fabs catch a temporary macroeconomic tailwind, massively boost their margins during a supply shortage, and then immediately revert right back to the mean the second the cycle turns. I demand absolute clarity on this. Are these gross margins just a temporary anomaly, or is this a permanent structural upgrade to the business? The data strongly indicates it is a permanent structural upgrade. Gross margins expanded to 26.7% in Q4, up from 22.7% a year earlier. Let me break down the actual economics of a semiconductor fab for a second so we understand exactly why this matters so much. Look, a fabrication plant costs billions of dollars to build and hundreds of millions of dollars a year just to run. Those fixed costs remain exactly the same whether you are manufacturing cheap, low-end commodity chips for calculators or highly advanced, incredibly expensive processors. By shifting their factory utilization toward advanced RF and silicon photonics, the margin profile of the entire company permanently shifts upward. Because the machines cost the exact same to operate, every single new dollar of high-end revenue essentially falls straight down to the bottom line. This isn't a pricing fluke or a temporary shortage. This is the pure mathematical power of operational leverage at scale. Section 3, the catalyst, Silicon Photonics. All right, you mentioned Silicon Photonics, and that brings me to my absolute biggest question of this entire teardown. What is the true catalyst here? Is Tower Semiconductor actually building a real defensible economic moat, or are they just casually riding the coattails of the current AI data center hype cycle? Oh, they are absolutely building a moat, and they are providing the essential picks and shovels for the AI gold rush. The moat is incredibly deep. Let's break down what Silicon Photonics, or SiPho, actually does in the real world. In a modern AI data center, you have thousands of GPUs processing absolute mountains of data. Moving that much data over traditional copper wire creates a massive bottleneck and generates extreme system crashing heat. Silicon Photonics solves this by using lasers, actual light, to move data instead of electricity. Tower is manufacturing the optical transceivers, doing the heavy lifting for these data centers, scaling SiPho for 1.6 terabit optical modules designed specifically for NVIDIA networking protocols. But here is the really critical part that people miss. It's not just data centers. They are also partnering with companies for FMCW LiDAR applications. To put it simply, LiDAR acts as the eyes for autonomous robots and self-driving vehicles. This is a massive secondary market outside of just AI servers, meaning their foundation is widely diversified across multiple high-growth industries. And if you want proof that this isn't just a fleeting hype cycle, here is the undisputed evidence. Boom. $1.3 billion. That is Tower Semiconductor's contracted Silicon Photonics backlog specifically for the year 2027. And listen to me. This isn't just a polite promise or some non-binding letter of intent from customers who might change their minds. This is backed directly by massive cash prepayments to secure factory capacity.
Okay, I have to jump in here because that is highly unusual. In the semiconductor industry, cash prepayments are incredibly rare. Usually, the fabrication plant takes on all the massive financial risk to build the factory, just hoping the demand is still there when the doors finally open. If customers are literally handing over cash years in advance, that signals pure desperation to secure supply. I'll admit, $1.3 billion in contracted revenue secured by actual cash prepayments is a remarkably solid pillar. But does that blueprint actually translate into bottom-line durability in the long run?
Absolutely it does, because management has laid out an ambitious but structurally supported blueprint for 2028. They are targeting $2.8 billion in annual revenue, which will pull through an incredible $750 million in net profit. The internal scaffolding supporting this massive leap in profitability is their 300mm strategy execution. Look, in chip manufacturing, moving to a 300mm wafer is like upgrading from baking a small personal pizza to a massive extra-large pizza. You get significantly more slices, or in this case chips, per bake, which dramatically lowers the cost per chip and naturally widens the profit margin. The recent restructuring transaction in Japan toward full ownership of Fab 7 accelerates this whole process. They are locking in the 300mm capacity right now to fulfill that $1.3 billion backlog at peak profitability. Section 4. Stress test, valuation, and CapEx. Okay, you've painted a beautiful picture of the future, but I'm taking control of the teardown right now. We are going to initiate a stress test on this stock. I want to look for actual cracks in the armor, specifically regarding their current valuation and their highly aggressive capital expenditures.
Let's look at the multiple. When evaluating enterprise value to sales, Tower is currently trading at a premium 6.5 times multiple. Now, the peer average is only 5.7 times. Slower growing legacy peers like Global Foundries and United Microelectronics, companies that also manufacture chips, but without those pure AI tailwinds, they're trading at significantly lower multiples. The Zacks report just gave Tower a $150 price target. I really have to question the structural integrity of that multiple. Is this valuation simply too rich? Are we paying for absolute perfection in a market environment that rarely ever delivers it?
I will vigorously defend this premium valuation, and the reason is simple: their ironclad balance sheet. Tower is sitting on a massive $1.2 billion in cash and short-term deposits. Think about that. That equates to $10.25 in cash per share just sitting on the books, earning 4 to 4.5% interest. Compare that absolute mountain of cash to a mere $162 million in total debt. This cash pile is the ultimate protection against cyclical macro downturns. You gladly pay a premium multiple for a company growing its top and bottom line double digits while carrying virtually zero net debt. It means they completely control their own destiny.
Look, the cash pile is impressive, I'll give you that, but they are going to need every single penny of it. Building these fabs requires immense capital. Fabs are notorious for being absolute cash incinerators if demand suddenly dries up. We are looking at $200 to $240 million purely for routine maintenance, another $100 million in Agrit, Italy, $255 million in New Mexico, another $300 million just to expand SiPho capacity across Israel, Texas, and Japan. And they just dropped a $111 million lease prepayment for Fab 3 in California. My worrying here is super simple. This heavy spending could easily burn through their free cash flow. If AI demand blips even slightly, this aggressive CapEx becomes a structural collapse.
That is a totally fair warning in a normal environment. But as we established, this is not a normal environment. I counter your CapEx risk argument with this metric right here: $509.9 million. That is the operating cash flow Tower generated in the first quarter of 2026 alone. How did they achieve that massive number in a single quarter? Because it was heavily bolstered by $290 million in direct customer prepayments. Tower isn't going to the debt markets or diluting shareholders to build these wildly expensive factories. Their customers are literally funding the build-out upfront. This dynamic essentially turns Tower Semiconductor into a risk-free toll booth for the AI infrastructure superhighway. The customers bear all the expansion risk, while Tower reaps the manufacturing reward.
Section 5, the outlook, record Q2 guidance. All right, the customers are paying for the scaffolding. That de-risks the CapEx significantly, I agree. But what about the immediate term outlook? We've talked a lot about 2027 and 2028. Is this scaffolding going to hold up through the upcoming volatility of the summer months? The immediate outlook is stronger than it has ever been. Management just revealed a record-breaking Q2 2026 revenue guidance of $455 million. That represents a 22% year-over-year increase, and it proves consistent sequential quarter-over-quarter growth. Furthermore, S&P's Mullet just reaffirmed Tower's ILA rating and actually raised their outlook from stable to positive. To translate that for the layman, an ILA rating means the massive, conservative credit markets view Tower's ability to pay back debt as incredibly strong. This significantly lowers their cost of capital for any future borrowing, completely cementing their financial integrity.
Section 6. The verdict. We've looked at the top line, we've scrutinized the margins, we've stress-tested the balance sheet, and we've heavily analyzed the capital expenditures. It is time to deliver the final verdict on Tower Semiconductor's structural soundness.
Here is my definitive verdict. Tower Semiconductor is a solid opportunity to forge long-term wealth. This is not a fragile stock built on hot air. Let me summarize the specific pillars supporting this thesis. First, they have an impenetrable moat in Silicon Photonics, backed by a $1.3 billion prepaid backlog. Second, their transition to 300mm wafer manufacturing guarantees permanent margin expansion. And third, they are carrying virtually zero net debt. The premium valuation is entirely justified by their unique, risk-mitigated position in the AI infrastructure supply chain. You know what? I've stress-tested the numbers, and I have to concede. While a 6.5 times EV to sales valuation absolutely requires us to monitor their operational execution closely, the fact that customers are prepaying hundreds of millions of dollars to fund their strategic capital expenditures shows there is genuine, desperate demand. I see no signs of a value trap here. The structural integrity holds up.
And this entire teardown brilliantly illustrates the difference between a high flyer built on hype and a true market leader built on heavy lifting. We challenge you to stress test your own portfolio today. Are you holding companies with multi-billion-dollar backlogs and massive cash reserves, or are you holding fragile value traps? Let us know in the comments if you are buying the TSEM breakout or if you are sitting on the sidelines waiting for a pullback. Keep forging a stronger portfolio. We'll see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.